Hello, you're tuning into House Lux Estate, the channel that makes finance and real estate simple and straightforward. Today, we're pulling back the curtain on a crucial tool for ensuring financial stability: bank stress tests. These tests measure how banks would weather financial storms, and their results can help prevent crises before they occur. It's a topic that may seem complex, but we're here to break it down for you. So, buckle up as we dive into the world of financial stability and bank stress tests. First off, let's make sure we're all on the same page about what a bank stress test is. Think of it as a health checkup, but instead of checking your body, we're examining the health of a bank. It's a way to measure how a bank would handle a severe economic downturn or financial crisis. Imagine a doctor who is trying to predict how a patient might handle a disease. The doctor might consider things like the patient's current health, lifestyle, and genetic factors. Similarly, a bank stress test takes into account a bank's current financial condition, how it operates, and the economic environment it's in. This test is all about hypothetical scenarios. It's like asking, what if there was a significant increase in unemployment, or what if there was a sharp decline in real estate prices? It's these hypotheticals that help us understand the resilience of our banks. Now, the question arises, why do we need these stress tests? Well, the simple answer is to prevent financial crises. Remember the financial collapse of 2008? Had there been proper stress testing, we might have seen the warning signs and taken measures to prevent it. These tests are conducted by regulatory bodies, and banks are required to pass them. If a bank fails, it may have to take measures to strengthen its financial health, like raising more capital or reducing risk. But remember, it's not just about passing or failing. The results of these tests also guide banks in their decision-making process. They can help banks identify vulnerabilities and take corrective actions before it's too late. Stress tests also provide transparency. They allow the public and investors to understand the risks banks are taking. This transparency builds trust and confidence in the banking system. So, in essence, a bank stress test is a preventive tool. It's a way to anticipate potential problems and address them before they become full-blown crises. It's about making sure our banks are strong enough to weather the storms they might face in the future. Think of it as a what-if scenario to see how well our banks would handle a financial downturn. Now that we know what a bank stress test is, you might be wondering, why do we even need them? Well, bank stress tests are like a health checkup, but for the financial sector. They are crucial tools used by regulators worldwide to evaluate how banks can handle different adverse economic scenarios. The primary goal of these tests? To prevent financial crises. Imagine a world without bank stress tests. Without this early warning system, banks could unknowingly take on too much risk, leading to massive losses when the economy takes a downturn. These losses could then cause a domino effect, leading to a broader financial crisis. We've seen this happen before in the 2008 financial crisis, which was partly due to banks overextending themselves without realizing the consequences. Now, by simulating adverse scenarios, bank stress tests allow regulators and banks themselves to identify vulnerabilities and take corrective action before it's too late. They provide a kind of what-if analysis that can help banks understand how their balance sheets might be affected by various economic shocks. In addition, stress tests also promote transparency and accountability. They ensure that banks are open about their risk levels, making it easier for everyone to see if a bank is taking on too much risk. This transparency can also help to restore and maintain public confidence in the banking sector, which is particularly valuable in times of economic uncertainty. Moreover, stress tests play a key role in maintaining financial stability. By ensuring that banks have enough capital to withstand economic downturns, they help prevent bank failures. This, in turn, helps to maintain public confidence in the financial system and prevent bank runs, where large numbers of customers withdraw their deposits simultaneously out of fear that the bank might collapse. So, these tests are not just for the bank's benefit, but for the economy as a whole. They are a vital tool in our arsenal to prevent financial crises and ensure a stable and healthy banking sector. They help to keep our financial system resilient, able to withstand shocks, and ready to support the economy through thick and thin. Remember, a healthy banking sector is a prerequisite for a healthy economy. So bank stress tests are not just important, they're essential. So these tests are not just for the bank's benefit, but for the economy as a whole. All right, we know what they are and why they're important, but how do these stress tests actually work? To put it simply, bank stress tests are a bit like a health checkup for banks, ensuring they're fit enough to weather financial storms. The first step in a bank stress test is the development of hypothetical scenarios. These are not your average rainy days, but rather financial tsunamis that could potentially crash the economy. These scenarios can range from a sudden increase in unemployment rates, a drastic drop in the housing market, or even a global recession. These hypothetical situations are carefully crafted, taking into account varying economic factors and their potential impact. Once these scenarios are established, the banks step in. They are asked to play out these situations, applying them to their current financial status. This process involves a thorough assessment of the bank's balance sheets, capital levels, and risk management strategies. The aim is to see how the bank would respond if these hypothetical scenarios were to become reality. Would they have enough capital to cover their losses? Could they continue to lend money and support the economy? Then comes the interpretation of results. The results of these tests are analyzed meticulously by the regulatory authorities. They look at how much capital the banks would have left after facing such adverse situations. If a bank's capital drops below the required minimum, it's a red flag. This could mean that the bank is at risk of failing if such a situation were to actually occur. But it's more than just passing or failing the test. It's about how well a bank can maintain its operations under stress. If a bank can hold its ground during these tests, it gives regulators, investors, and the public confidence that it can withstand real-life economic downturns. However, if a bank doesn't fare well, it's not the end of the road. They are given the opportunity to revise their plans, bolster their defenses, and come back stronger. So, it's not just about surviving the stress test, but how well a bank can maintain its operations under stress. Like any system, bank stress tests aren't perfect. That's right. Despite their essential role in maintaining financial stability, there are a handful of criticisms and limitations that these tests face. First off, let's consider the hypothetical nature of these tests. They're based on imagined adverse scenarios, which, despite being modeled on historical financial crises, can never fully encapsulate the unique conditions of a future downturn. It's like trying to predict the exact course of a hurricane. We can forecast its general path based on past data, but the precise twists and turns? Those can catch us off guard. Similarly, stress tests might not always predict the exact impact of a financial crisis on a bank's health. They're great for providing a general idea of a bank's resilience, but they're not foolproof. For instance, the global financial crisis of 2008 had effects that were far more widespread and complex than most models had anticipated. Then there's the issue of transparency. While it's crucial for regulators to maintain a level of secrecy to avoid gaming of the system, this can lead to a lack of understanding about the process among the broader public. This, in turn, can fuel skepticism and mistrust. Additionally, these tests can inadvertently lead to a false sense of security. A bank that passes a stress test is not immune to failure. It simply means that it's likely to withstand the specific scenarios tested. But remember, the financial world is a complex and unpredictable beast. Finally, let's not forget the cost. Running these tests is expensive and time-consuming. Banks have to dedicate significant resources to this process, which can detract from other areas of business. Despite these limitations, stress tests remain a crucial tool in our financial stability toolkit. They provide a valuable snapshot of a bank's health, helping to prevent devastating financial crises, or at least better prepare us for them. So while they're not perfect, they're certainly a step in the right direction. So we've covered quite a bit today about bank stress tests. We started by simplifying the concept of bank stress tests. We learned that these tests are essentially a simulation, a way for regulators to gauge how a bank would fare under unfavorable economic conditions. It's a bit like a financial health checkup for banks, ensuring they have the strength to weather economic storms. We then dived into the importance of these tests. Stress tests are crucial in maintaining financial stability and preventing financial crises. They provide a safety net, ensuring banks have enough capital to absorb losses and continue operations during tough times. It's like having a lifeboat ready in case the ship encounters a storm. We also looked at how these tests are conducted. The process includes creating hypothetical adverse scenarios, calculating potential losses, and assessing whether the bank has sufficient capital to absorb these losses. It's a rigorous process that requires detailed financial knowledge and understanding. However, we also acknowledged the criticisms and limitations of bank stress tests. They are not foolproof, and there's always a possibility of error in the assumptions made during testing. It's important to remember that even the most well-designed stress test can't predict every possible outcome. Remember, a financially stable economy is a thriving economy. Don't forget to subscribe to House Lux Estate for more insights into the world of finance and real estate. Until next time.